Hello, I'm Paul Ferneyhough, Head of Investor Relations here at Repsol. On the 28th of July, Repsol presented its second quarter 2016 results. The first half of the year has seen a continuation of the challenging and volatile macro environment that our industry, has been facing over the last 6 quarters. At the macroeconomic level, during the second quarter, oil prices recovered marginally compared to the first quarter of this year, with Brent crude averaging $45 per barrel, compared to $34 in the first quarter of 2016 and $62 in the second quarter of 2015. Gas prices were stable versus the first quarter, with Henry Hub averaging $2 per million BTU, lower than the $2.60 observed in the second quarter of 2015. Repsol's integrated business model and the inclusion in 2015 of acquired assets into our portfolio have allowed the company to deliver a strong set of results despite the continued challenging environment. CCS adjusted net income was €345 million and €917 million for the quarter and the first half of the year, respectively. In the upstream, adjusted net income for the second quarter was €46 million positive, €94 million higher than in the same period of 2015. Lower commodity prices were offset by increased production volumes, lower costs, and lower exploration expenses. Average production in the quarter stood at 697,000 barrels of oil equivalent per day. This is 33% higher year on year, mainly due to a full quarter of volumes from acquired assets versus only a partial contribution into the second quarter of 2015, together with the ramp-up of the Cardon 4 project in Venezuela and the Sapinhoa project in Brazil, contribution from the Gudrun field in Norway, and higher production in Peru. In the downstream, the CCS adjusted net income in the quarter was €378 million, 14% lower than in the second quarter of 2015 when we achieved record refining margins, and were benefiting from a full refining capacity throughout the quarter. In the second quarter of this year, the planned turnarounds at Cartagena and Tarragona refineries have reduced, as expected, both our distillation and conversion capacity utilization. As a result of this, our actual margin for the quarter was close to our refining margin indicator. Nonetheless, the sustained strength of the chemicals business and improved commercial business results delivered another overall quarter from this division. With regard to Gas Natural Fenosa, adjusted net income in the second quarter of 2016 amounted to €96 million, 9% lower year on year, mainly due to lower profits from the gas commercialization business, but very much in line with the current price environment. The consolidated second quarter net financial result was negative €185 million, broadly in line with the second quarter of last year. During the second quarter, Repsol has opportunistically taken advantage of market conditions to reduce its overall cost of debt. The consolidated net financial debt at the end of the second quarter of the year amounted to €11.7 billion, a decrease of around €300 million compared to the previous quarter end. Liquidity at the end of the first half of 2016 was approximately €6.7 billion. Including undrawn credit lines, this represents almost 2 times coverage of short-term maturities. Looking forward, although oil prices have improved in the second quarter compared to the lower levels observed earlier in the year, we at Repsol remain cautious on the short-term recovery of commodities and continue to focus our efforts on achieving cash neutrality at around a $40 Brent price level. The delivery to date across our integrated business gives us confidence that we're moving towards the delivery of our overall strategic goals. Thank you very much for your time.